Welcome to ICMA's Education Self-Study course for Collateral Management. This course consists of a total of 4 main modules with several subjects presented in each of their own videos. When you have completed all 4 main modules, you will have met the following objectives. What is collateral and the purpose of its service? Identify the various transaction types requiring collateral. What causes exposure for financial institutions? The different types of collateral and their characteristics. Reasons for legal protection and associated documentation, components in collateral call calculation, making and receiving collateral calls, handling collateral substitution and income payments, and finally, primary risks and mitigating controls throughout. To understand collateral management and all the related activities, we first have to understand what collateral is. Collateral can be generically described as assets that provide security to those that are owed assets. Thus, a creditor can minimize or reduce the risk of not having an asset returned. To better understand what that exactly means, we have to know how collateral is used in the financial marketplace. The provision of collateral is done by one party to another, for example, Bank A to Bank B, and is commonly considered a daily activity in financial services. However, though this is ideally done on a daily basis, it is not necessarily done daily. The provision applies to a variety of transaction types, each of which generates or has exposure. These can be secured cash borrowing, securities lending and borrowing, repo transactions, and OTC derivatives. This course will use repo transactions and OTC derivatives known as interest rate swaps and credit default swaps as product examples to understand how exposure arises and how it fits into the collateral management activities. And don't worry if you have not worked with any of those products before. We will give you an introduction to these products before going into the details. Let's look at how collateral works. Collateral is used whenever an asset is lent and whenever money is owed, as in an OTC derivative. Whether cash or securities, the collateral may be given by the borrower or by the party in debt. To better understand how this works, let's have a look at these two diagrams. The first diagram applies to repo transactions. In a repo transaction, we have two main flows. Flow 1, which is typically referred to as the opening leg, and flow 2, which is usually referred to as the closing leg. In the opening leg, the lender, which we have to our left, lends the asset to the borrower, while the borrower on the right side moves collateral to the lender. This happens at the same time and is referred to as the simultaneous exchange. And when the repo transaction ends, also called closes, the closing leg is executed, but with opposite movement where the borrower returns the asset and the lender returns the collateral. The second diagram refers to OTC derivatives. The common aspect of such transaction is that they usually start equal but accumulate value in favor of one party. Therefore, we only see the collaterals move from the party out of the money to the party in the money, illustrated with line number 1. When the trade matures, the collateral is returned, shown by line 2. And don't worry, later in the course we will look more into the details of these activities. This was a very brief overview of how collateral works. Let us now look at the benefits of using collateral. Using collateral has several benefits, so let us have a look at what some of those benefits are. One of the benefits for the lender is that the lender's risk is reduced if the borrower fails to repay the borrowed cash or securities, as the lender may sell collateral to recover the value. The benefits are not limited to the lender alone. The borrower's costs are reduced as the borrowing fee is reduced when borrowing is executed secured rather than on an unsecured basis. Additionally, credit risk is reduced. As counterparty exposure can be in tens of millions, this can prevent further trades as there is a potential for hitting a credit limit. As collateral reduces exposure, using collateral enables more trading. Finally, the uses of collateral reduces capital requirement, which is cash set aside for regulatory purposes, which we'll discuss later in the course. When we talk about collateral, we have to talk about if collateral has the same value, known as collateral value, as market value. The question for the collateral taker is, will the collateral hold its value so I can be certain of recovering the full value of my exposure in the event of a counterparty default? When talking about cash as collateral, the answer is yes. In general, there's no reduction in collateral value for major currencies such as US dollars or euros, as these are considered very low risk to the collateral taker. For bonds, there's typically a reduction in collateral value to take into account any potential fluctuation in bond prices. The collateral giver is required to provide a slightly greater value of collateral compared with the taker's exposure. For example, suppose 1 million in cash is being lent. In that case, the borrower may be required to provide collateral with a market value of 1,020,000, 102% of the amount borrowed, to allow for a certain amount of fluctuation. The additional 2% is known as valuation percentage or haircut. The haircut size depends on several factors, including issue type, rating, and residual maturity. When collateral has been posted to what we call the collateral taker, we have to consider what happens to the value of that collateral while it's in possession of the collateral taker. Most securities are subject to price fluctuation on most business days. Where securities are provided as collateral, a price increase may cause the collateral value to rise above levels required by the lender, putting the borrower at risk, who then may make a margin call to recover excess collateral from the lender. Opposite, if the price decreases, it may cause the collateral value to fall beneath the levels required by the lender, and now the lender is at risk of not being able to recover the full value of the loan and may make a margin call to receive further collateral from the borrower. As you may remember from previously, valuations should preferably be done daily, and this is the exact reason, as prices of securities are likely to either increase or decrease during business days. Both the collateral taker and giver have an interest in checking on an ongoing basis if they have received or posted enough collateral. Therefore, to protect both the interest of the lender and the borrower, they should both revalue the collateral at an agreed frequency to ensure that they are not at risk, or they are at risk and take appropriate action. Until now, we've talked about collateral from a traditional repo transaction perspective, so let's have a quick look at how collateral is used in OTC derivatives. At the start of an OTC transaction, both parties are considered to have equal risk, so at that point in time, it is not necessary from either party's perspective to post collateral. However, as an OTC derivative trade accumulates value over time, collateral must be provided to the party that is owed cash. For example, an investor executes an interest rate swap with counterparty T. On agreed dates, the position is marked to market by both parties. If the value of the contract has accumulated in favor of the investor counterparty, T must provide collateral to the investor. On the other hand, if the value of the contract has accumulated in favor of counterparty T, the investor must provide collateral to counterparty T. The provisioning of this collateral is known as a margin call. When the investor or counterparty T has performed the valuation and determined that a margin call must occur, they have to consider the forms of collateral to use, and while doing so, they have to ensure they are certain of the recovery value. While considering the certainty of recovery value, they have to consider the certainty whatever the form of collateral. While ultimately documented in the credit support annex, the typical collateral available are cash or securities, and when securities, these are often highly rated bonds, such as government bonds issued by selected European national governments or US Treasuries securities. Lesser rated due to the higher level of risk associated are equities and letters of credit. And while considering what collateral to use, an important question to remember is if the usage of collateral eliminates credit risk, and the question is no. It is a critical point always to remember that collateral does not eliminate risk, it only mitigates said risk. This is understood by looking at the time element in collateral processing, through which both exposure and market value can fluctuate over time, and sometimes over very short periods of time. A good and simple way to understand this is to look at today, where the exposure equals 100, which collateral covers with a market value of 102. Tomorrow, your exposure equals 108, but the market value of the collateral changes to 95. This illustrates how over just one day, the movement of exposure and collateral value requires additional value to be posted over just one day. We have looked at basic collateral concept, but it is equally important to understand why there is an increased focus on collateral. Historically, collateral management has existed in financial services firms but has not been regarded as of great importance. In that context, the concept of using collateral is not new. However, after the financial crisis over a decade ago, 2007 and 2008 to be more precise, the financial sector had a realization that collateral management is a vital function. Additionally, there's been a significant regulatory push towards uses and periodic reevaluation of collateral. In some instances, the understanding of periodic is even intraday valuation. An example of such could be a central counterparty, also known as a CCP, that performs revaluation at opening in the morning, at noon, and closing of the day. And while the uses and movement of collateral are often considered related directly to exposure, it has the implied function where it effectively equalizes the trading relationship between two parties with different credit ratings. Later in the course, we'll be revisiting how credit ratings impact the posted collateral as a result of those ratings being subject to credit downgrades, an element that became very visible during the financial crisis in year 2007 and 2008. While historically, the frequency of valuing trades to determine profit and loss may have been monthly, the increased focus has led institutions to reconsider the frequency. It is therefore much more likely that the valuation is now weekly or even daily, with the daily being the predominantly chosen frequency. By now, we have looked at the essential elements that go into collateral management, including a brief overview of the reason for the increased focus. While this is important, it is equally important to understand the steps that go into managing collateral. These various steps can be considered in the sequential order referred to as the collateral lifecycle. While we'll go into the details of each step during the course, these are: both parties negotiate and ultimately sign legal documentation containing collateralization terms and conditions. Trading commences, and trades are marked to market for the first time. The party making a mark-to-market loss delivers collateral to the party making a mark-to-market profit. Trades are marked to market at agreed intervals. Following the latest mark-to-market, more collateral is given, or some/all collateral is returned. The underlying trade matures or closes, and following trade closure, collateral is returned to its owner. As mentioned, we'll become much more familiar with each of these steps as we make our way through the course. That completes this video. Please complete the concept checking quiz before progressing to the next video, and remember to use the discussion board if you have any questions.